Problem 5-36 on page F193 takes the matching principle one step further and includes depreciation. Now, as you read in your chapter, depreciation is a method where the purchase of a large capital item can be spread over a number of periods, usually years but sometimes months, in order to match the expense of purchasing the item with the income generated by its use. As you can see from the book, the company bought a commercial stitching machine in July for $25,000. The owner estimates the machine will be useful for 5 years and will have no residual value at the end of those 5 years. In other words, the owner estimates that he will be unable to sell the machine at the end of the 5 years for any money. Requirement A asks us to assume cash basis of accounting and calculate the expense for the years 2004, 2005, and 2006. On your screen, you see a little format that can be used to answer these requirements. Using a cash basis, the cost of the machine will be recognized as an expense in the year in which it is purchased. In other words, on the format in front of you, in year 2004, $25,000 is the answer. Since the entire cost is recognized in 2004, in 2005 and 2006, there's no more cost to recognize, so both have zero expenses for this machine. Requirement B asks for the same analysis using the accrual method of accounting. To accomplish this, the annual depreciation will need to be calculated. To do so, the net cost of the machine is divided by the number of years of estimated life. In most circumstances, the net cost would be calculated by subtracting any estimated residual value from the cost of the item. In this case, there is no residual value, so the net cost is $25,000. Divide that $25,000 by 5 years, and the annual depreciation is $5,000 per year. For the purposes of this statement, however, the machine was only in use for half of the year. Therefore, the 2004 expense for this machine is $5,000 divided by 2, or $2,500. For the years 2005 and 2006, the depreciation is the $5,000 that was calculated for a whole year's use. Requirement C asks us to do a cash basis analysis on the balance sheet for this particular purchase. In 2004, the company paid $25,000 for the machine and expensed the entire $25,000. Because the money has been totally expensed already, there is nothing left to show on the balance sheet. Therefore, the net value for the balance sheet for all 3 years is 0. Requirement D is probably the most difficult of the 4 requirements in this problem. But by using formulas in the cells in the Excel spreadsheet, we can make it much easier. If a balance sheet was created on the day the machine was purchased, it would show an asset value of $25,000. During the balance of the year, it has already been ascertained that the depreciation on the machine will be $2,500. Therefore, at the end of 2004, the balance sheet will show a net asset of $25,000 less $2,500, or $22,500. This can be put into the Excel as $25,000 minus the cell on the accrual-based income statement for 2004 depreciation. For 2005, the net asset starts at the $22,500, and depreciation shown on the accrual basis income statement is $5,000. Once again, using a formula on the Excel spreadsheet, the calculation can be done by subtracting the depreciation on the accrual-based income statement from the prior net assets in the cell above. For the year 2006, all that needs to be done is to copy the cell from 2005 to 2006. That should yield the correct result.